Hey everybody, thanks for clicking on this one. We really need to talk about something that just happened in the financial world recently. Something that almost nobody in the mainstream media actually picked up on or even bothered to explain to regular folks like us. It was basically this quiet little rule change that got buried deep inside this massive, super boring regulatory document. But honestly, it's kind of the financial equivalent of a tectonic plate shifting right underneath our feet. I mean, we are talking about a fundamental rewiring of how the entire global banking system looks at money. You know, most of the time when we think about money, we picture digits on a screen or maybe some crumpled bills in our wallet if we're still carrying cash around. But there's this whole other level to the game, a level where nations and these massive institutions are playing. And at that level, the rules just change big time in favor of the oldest form of money on earth, gold. To really wrap our heads around what happened and why it's so massive, we kind of have to take a little trip over to Basel, Switzerland. There's this building there. It's this strange cylinder-shaped tower that looks like it could be straight out of a sci-fi movie or something. This is the Bank for International Settlements, or the BIS, as everybody calls it. Basically, if you think of your local bank as the place where you keep your paycheck, and the Federal Reserve or the European Central Bank is where your local bank goes to get its money, well, the BIS is like where those central banks go to sort things out. It's essentially the central bank of central banks. They're the ones who set the ultimate rules for the whole global financial system. They kind of operate above governments, above regular laws in a way. They even have diplomatic immunity, which is pretty wild when you stop and think about it for a second. Anyway, the BIS has this specific committee called the Basel Committee on Banking Supervision, and they're the ones who come up with what we know as the Basel Accords. To get why this particular rule tweak matters so much, we've got to rewind a bit to like 2008, that whole great financial crisis mess. You remember that, right? The global economy basically melted down because commercial banks were taking on these insane amounts of risk with money they didn't really have. They were way over-leveraged, holding all these toxic mortgage-backed securities that, the rating agencies had called perfectly safe but turned out to be completely worthless. So when the housing music stopped playing, banks started failing left and right, and the whole credit system just froze up. The BIS looked at that disaster and basically said, okay, we need much stricter rules so this never happens again. That's where Basel III comes in. It's this huge, incredibly complex set of international banking regulations designed to make sure banks actually have enough safe, solid capital sitting on their balance sheets to survive another sudden crisis. You could kind of think of it as an enforced lockdown savings account for the too big to fail banks. Now, under these Basel III rules, bank capital gets divided into different tiers depending on how safe, stable and liquid it is. Tier 1 is the absolute best stuff, the highest quality capital a bank can hold. We're talking cash and sovereign debt like US treasuries or German bonds, things that regulators see as having basically zero counterparty risk. If a bank holds $1 million in Tier 1 capital, the regulators go, cool, we value that at exactly $1 million. You get full 100% credit for it on your books. Then you've got Tier 2 and Tier 3 further down the ladder, which are much riskier assets. We're talking certain stocks, corporate bonds, and yeah, for the longest time, physical gold was lumped in there too. You heard that right. For decades, physical gold, the stuff that's been the ultimate form of money for over 5,000 years of human history, was treated like a highly risky Tier 3 asset by these central bankers running the show. It was kind of crazy to see. If a commercial bank held actual physical gold bars in its vault, the BIS rules slapped a 50% haircut on it. That means if they had $1 billion worth of real gold sitting there safe and sound, regulators would only let them count 500 million toward their capital requirements. They were basically punishing banks for holding the real thing instead of paper promises. Why? Well, the official reason was always price volatility in the markets. But if you dig a little deeper, it was because the whole modern financial system is built on paper debt and credit. They wanted banks loaded up on sovereign debt. Those are just IOUs from politicians, not independent physical wealth that has zero counterparty risk and doesn't need any government to keep working. So holding actual gold was kind of a dumb, inefficient move for a bank under the old rules. It tied up way too much capital for not enough reward. But here's where it starts to get really interesting, and stick with me, because this part blew my mind when I first dug into it. While holding real physical gold got heavily penalized, messing around with paper gold was totally fine and even encouraged. You've got to understand how the modern gold market actually operates today, especially in big hubs like London through the London Bullion Market Association, or LBMA. Most of the gold that gets traded back and forth every single day isn't actual shiny bars moving around in armored trucks. It's what they call unallocated gold, basically just a bank's promise to deliver gold sometime in the future. It's a pure derivative contract. A bank might only have 1 real ounce sitting in the vault, but they could sell 100 separate paper claims on that same ounce to different investors. It's this massive fractional reserve setup for gold. And under the old banking rules, those unallocated paper contracts got treated way better than the actual metal. Banks could trade them endlessly, use them to keep the price of real gold suppressed, and even use the paper as collateral in other deals. It was like this huge, highly leveraged casino built on top of a tiny sliver of actual physical gold. Then, as the final strictest stages of Basel III started rolling out, the BIS did something that shocked a lot of people who actually watched the plumbing of the financial system. They introduced this rule called the Net Stable Funding Ratio, or NSFR. And as part of pushing for real stability, physical allocated gold, specific bars with serial numbers that a bank actually owns outright and keeps in its own vault, got quietly reclassified. It jumped all the way from that risky Tier 3 spot with the 50% haircut up to pristine Tier 1 risk-free status. Literally 100% valuation, no penalties at all. Suddenly, overnight in the eyes of international banking law, holding physical gold is treated exactly the same as holding cash or the safest government bonds. So why the sudden change of heart? Why did these elite rule makers who spent decades trying to push gold out of the mainstream suddenly decide it's prime money again? Well, there are a few big reasons, and they're kind of scary if you really sit with them for a minute. Look, the central bankers at the BIS aren't dumb. They can see the writing on the wall for the global economy. Ever since that 2008 crisis, the go-to fix for every problem has been to just print more money out of thin air. Quantitative easing, bailouts, stimulus checks. They've flooded the world with trillions in fiat currency. Global debt levels have exploded to numbers that are basically impossible to pay back normally. Because of all that, sovereign debt, which was supposed to be the ultimate safe Tier 1 asset, is starting to look not so safe anymore. When major countries are running multi-trillion-dollar deficits year after year, and central banks are just printing to cover it, those paper promises lose credibility fast. Inflation runs hot. We've all seen it. And suddenly a bond yielding 2% is a loser if prices are rising 6%. The BIS regulators kind of realized, maybe a bit late, that they'd built the whole system on counterparty risk. Every asset a bank holds is somebody else's liability. Cash is a central bank's IOU. Treasuries are a government's promise. Unallocated paper gold is a bullion bank's promise. If that trust chain snaps anywhere, the whole thing collapses. Physical gold, though, it's the only financial asset on the planet that isn't somebody else's liability. It doesn't need a politician, a bank, or a digital ledger. You hold it, you own it. No counterparty risk whatsoever. So by reclassifying physical gold as top-tier capital, the BIS is basically admitting that, in a real worst-case scenario, when paper promises fail and inflation rages, the only thing that saves a bank's balance sheet is hard, tangible assets. They're telling the big banks to get ready for a world where trust in paper might evaporate overnight. And this rule change has this massive cascading effect that's shaking up the bullion banks right now. Remember that leveraged unallocated paper gold market? Under the new Basel III NSFR rules, holding those paper contracts has become almost prohibitively expensive. Regulators are saying if you want to play in the paper casino, you need to hold a ton of your own cash in reserve. They're penalizing the derivative side hard while rewarding the physical side. It's like they're deliberately squeezing the dangerous leverage out of the gold system before it blows up in everyone's face. They finally get that if a real crisis hits and everybody demands actual delivery at once, the bullion banks would default because there simply isn't enough physical gold to cover all the paper claims. So they're using the heavy hand of regulation to force banks to either stock real gold or get out of the game. Picking up from there, we've got to step back and look at what the major central banks themselves are doing right now, because it's fascinating and a little terrifying when you connect the dots. While the BIS was writing these new rules that made physical gold Tier 1 again, central banks around the world went on this unprecedented buying spree. For decades, Western central banks were net sellers of their gold reserves. They told the public, hey, this is just an old pet rock. We don't need it anymore in the digital age. Fiat is the future. But right around the 2008 crisis, and as these Basel rules were being drafted, they flipped completely. Suddenly they're hoarding physical gold at rates we haven't seen since the Bretton Woods system fell apart in the 1970s. It's this wild disconnect playing out in real time. The Federal Reserve, the ECB, all these big players go on TV saying everything's fine, inflation is under control, the system is rock solid. But behind the scenes, their actions scream something else. By buying up thousands of tons of physical gold, they're building themselves a financial lifeboat. They're quietly front-running the devaluation of their own currencies. They know the fiat system is mathematically broken. They've printed way too much. The debt mountain is unpayable in real terms. So they're using whatever fiat they have left to grab the only true counterparty-free asset out there. And you can't ignore the geopolitical side of this either. If you look at who's buying all this gold, it's mostly the central banks of the BRICS nations, Brazil, Russia, India, China, South Africa, and a bunch of other emerging markets. They're draining Western vaults dry. For years, these countries played the Western game, stacking up US treasuries and holding dollars. But they watched the US weaponize the dollar, sanctions, freezing reserves over politics. So they're thinking, why keep our national wealth in a paper asset our rivals can switch off with a keystroke? They're de-dollarizing fast, and physical gold is their weapon for real independence. By making allocated gold a Tier 1 asset, the BIS has basically given this huge shift of wealth and power from west to east an official blessing, whether they meant to or not. Eastern nations don't mess with the leveraged paper game London and Wall Street love. When China buys gold, they take delivery, load it on planes, and fly it home to their vaults. They want the real metal. So while Western commercial banks scramble to unwind their toxic paper positions because Basel III makes them too expensive, the Eastern central banks are sitting pretty on mountains of new Tier 1 capital. It's this silent wealth transfer happening right under our noses. Now the big question everybody asks is, what does this mean for the actual price of gold going forward? For decades, gold's price has been suppressed by those same bullion banks trading unallocated paper contracts. They could create endless artificial supply to smash the price whenever it threatened fiat stability. But if Basel III forces those banks to step back from the paper casino or hold huge reserves to keep playing, that manipulative supply dries up. We're entering a new era where real physical price discovery finally gets unleashed. When the paper chains break, the price of the metal has to re-rate to reflect all the inflation and debasement over the last 50 years. We also have to look at the global debt spiral to see the end game. The world is drowning in over $300 trillion of debt, with interest rates up from zero. Just servicing that debt is becoming impossible for most countries. The US alone spends over $1 trillion a year on interest. It's insane. The only realistic way out is massive prolonged inflation. Governments devalue their currencies to make debt cheaper. It's a hidden default. But as they do that, institutions and central banks need a reliable anchor so their balance sheets don't collapse. That's where the quiet brilliance, or maybe desperation, of this Basel III gold rule shines. By elevating gold to Tier 1 risk-free status, they've built a golden floor under the banking system right before the big fiat devaluation. When trust in government bonds evaporates and cash means guaranteed losses from inflation, banks will now be allowed and encouraged to hold physical gold as core reserves. It's like quietly paving the way for a modern gold standard, not with coins in your pocket, but gold settling trade imbalances and anchoring the system at the highest level. And hey, you're probably wondering what this means for you, the regular person watching grocery bills and rent go through the roof. If the most powerful central banks and regulators are quietly hoarding physical gold and rewriting the rules to call it the ultimate safe asset, you should probably pay attention. They're flashing a giant warning sign that the paper money experiment is hitting its final volatile stage. The game changed overnight, even if the news didn't tell you. Start shifting your mindset away from measuring wealth only in fiat currency. If central banks are front-running the collapse of their own product by stacking gold, relying solely on dollars or euros for long-term savings is a risky bet right now. This quiet Basel III move on physical gold isn't just some bureaucratic footnote. It's a monumental shift in the global financial architecture. It's the architects of the system officially admitting that when the leveraged fiat debt bubble pops, the only thing left standing is tangible, counterparty-free physical wealth. The smart money has already moved. Now it's up to you to figure out how you're going to protect yourself in this new, well, actually very old paradigm. Let me just circle back for a second, because there's even more layers to this that I think are worth unpacking a little more slowly. Think about how gold has always been this constant through history. Empires rise and fall, currencies come and go, but gold keeps its value. Kings, pharaohs, merchants, they all trusted it when paper failed. And now, after decades of trying to sideline it, the very people who built the paper system are bringing it back in through the back door with these rules. It's almost poetic in a way, or maybe just pragmatic. They see the storm coming, the debt, the inflation, the loss of trust, and they're battening down the hatches with the one thing that survived every storm before. I was reading some old reports the other day about how central banks used to hold huge gold reserves after World War II under Bretton Woods, and how that system kept things stable until politics got in the way. Then Nixon closed the gold window in '71, and we went full fiat. Fast forward 50 years and here we are again, with the BIS essentially saying, yeah, maybe we need some of that old stability back. Not publicly, of course. They're not announcing it with fireworks, but through these dense regulatory pages that only the insiders read. And for the everyday investor, or even just someone saving for retirement, this could be huge. If banks start treating physical gold like cash on their books, demand from institutions could push prices higher over time. Not overnight, because these things move slowly but steadily as the paper leverage gets unwound. We've already seen gold prices climbing in recent years, and a lot of analysts point to exactly this Basel III shift as one of the quiet drivers. Add in the central bank buying from BRICS countries, the geopolitical tensions, the endless money printing, and you've got a setup where gold could finally break out in a way we haven't seen in a long time. But it's not just about price. It's about what gold represents, real independent wealth that no government can inflate away or sanction. In a world where digital currencies and CBDCs are being rolled out, where every transaction can be tracked and controlled, physical gold is the ultimate privacy and freedom play. The banks know it, the nations know it, and now the rules are catching up. So yeah, that's the story behind this quiet rule change. It's not flashy. It's not headline grabbing like a stock market crash, but it's the kind of deep structural shift that changes everything behind the scenes. The kind that years from now people will look back on and say, that's when the tide really turned. If you've made it this far, thanks for listening. Drop a comment if this made sense, or if you want me to dive deeper into any part of it, like how to actually think about adding some gold to your own portfolio without getting ripped off.